If you want to be a successful investor, you need to know how to value stocks. One way to do this is with valuation ratios. Valuation ratios tell you how much you are paying for something compared to what you are getting in return. Take the price to earnings ratio, or PE ratio, for example. You take the stock price, that's how much you are paying for the stock, and you divide it by the earnings, that's what you are getting in return. The higher the PE ratio, the more you are paying for the company's earnings. Valuation ratios can help you value stocks. A higher ratio means the stock is more expensive than a lower ratio. Value ratios can also help you determine if a company is over or undervalued by comparing the ratios of one company to other companies, or comparing a ratio today to the ratio in the past. In this video, you'll learn about 6 valuation ratios, how to calculate them, and what they tell you about a company. As I mentioned earlier, the price to earnings ratio, or PE ratio, tells you how much you are paying for a company's earnings. To calculate it, we take the company's share price and divide it by the company's earnings per share. This video, I mentioned per share ratios a lot. If you don't know what they are, check out this video. Let's calculate Nike's PE ratio. In this video, I won't be using Nike's 10K. Instead, I'll be using Yahoo Finance. On the day I recorded this video, Nike had a share price of $75.92. And here, we can see Nike had an earnings per share over the past 12 months of $3.52. 75.92 divided by 3.52 equals 21.57. A PE ratio of 21.57 means you are paying $21.57 for $1 of Nike's earnings. If we flip the price to earnings ratio and express it as a percentage, we get the earnings yield. Earnings yield can be used to estimate the potential return on a stock. 3.52 divided by 75.92 equals 0.05, or 5%. That means if you buy a share of Nike, you are getting a 5% yield based on its earnings. All things being equal, a lower PE ratio means you are paying less for a company's earnings, which means you are getting a higher earnings yield. A common criticism of the PE ratio is that it does not take into account a company's growth. The price to earnings growth, or PEG ratio, attempts to remedy this. To calculate the PEG ratio, we take the company's PE ratio and divide it by the expected earnings growth rate. We just calculated Nike's PE ratio. It was 21.57. But where do we get the expected growth rate? One way, and possibly the better way, is to figure this out yourself. Another way is to look at what the professional analysts are thinking. If we click Analysis, we can see what the analysts are projecting. Scroll to the bottom and we can see analysts expect Nike to grow by 16.5% next year. So if we take Nike's PE ratio of 21.57 and divide it by the expected growth rate of 16.5, we get a PEG ratio of 1.31. This means you are paying 1.31 times what Nike is expected to grow by next year. The lower the PEG ratio, the less you are paying for the company's earnings growth. Fund manager Peter Lynch famously believed that a company with a PEG less than 1 was undervalued. Sometimes a company won't have any earnings. Usually these are companies that are very young and focused on growing their revenues. How do we value a company with no earnings? One way is with the price to sales ratio. It tells you how much you are paying for a company's sales. To calculate it, we take a company's share price and divide it by the revenue, or sales per share. We know the share price is $75.92. We need to calculate sales per share. To calculate sales per share, we divide total sales, or revenue, by the number of shares outstanding. To find total revenue, click Financials. Here we can see the numbers in thousands. Total revenue over the past 12 months was 50 billion. Shares outstanding can be found on the balance sheet. By default, Yahoo will show you the annual numbers, but I want the most recent numbers. I can get that by clicking Quarterly. The most recent shares outstanding is 1.49 billion. 50 billion in revenue divided by 1.49 billion shares outstanding gives us a sales per share of 33.54. Now we can calculate the price to sales. If we take the share price of 75.92 and divide it by the sales per share of 33.54, we get a price to sales of 2.26. A price to sales of 2.26 means you are paying $2.26 for each dollar of Nike sales. Our next ratio tells you how much you are paying for the shareholders' equity. It's the price to book ratio. The price to book ratio equals the share price divided by the book value per share. We have the share price, but we need to calculate the book value per share. Book value per share equals shareholder equity divided by shares outstanding. Shareholder equity is on the balance sheet. Here, they call it common stock equity. As of the most recent quarterly, Nike's shareholder equity was $13.9 billion. We already know shares outstanding, it was 1.49 billion. 13.9 billion in shareholder equity divided by 1.49 billion shares outstanding gives us a book value per share of 9.35. Now we can calculate the price to book. Take the share price of 75.92 and divide it by the book value per share of 9.35 gives us the price to book of 8.12. This means you are paying $8.12 for each dollar of shareholder equity or book value. Our next ratio tells you how much you are paying for a company's free cash flow. It's the price to free cash flow. Price to free cash flow equals the share price divided by the free cash flow per share. We already know the share price, we need to calculate the free cash flow per share. Free cash flow can be found on the cash flow statement. Over the trailing 12 months, it was $7.2 billion. We already know shares outstanding was 1.49 billion. 7.2 billion in free cash flow divided by 1.49 billion shares outstanding gives us a free cash flow per share of 4.84. Divide the share price of 75.92 by the free cash flow per share of 4.84 gives us a price to free cash flow of 15.7. That means you must pay $15.70 for each dollar of Nike's free cash flow. Our next ratio measures the return you are getting from dividends. It's the dividend yield. To calculate the dividend yield, we divide the dividend per share by the share price and express it as a percentage. We can find the dividend yield in the Statistics tab. Here we have the trailing annual dividend rate. It was $1.48. We know the share price is $75.92. 1.48 divided by 75.92 equals 0.019 or 1.9%. A dividend yield of 1.9% means for every dollar you invest in Nike, you are getting back 1.9 cents in dividends. Like all ratios, valuation ratios work best when they are compared to something else. If I wanted to value Nike, I would compare the ratios of Nike to other apparel companies such as Adidas, Puma, Lululemon, and Under Armour. If Nike's valuation ratios were less than the ratios of similar companies, then this might indicate that Nike is undervalued. I could also compare Nike's valuation ratios today to Nike's ratios in the past. Just look at this chart. It shows Nike's PE ratio of the past 10 years. Nike's current PE ratio is 21.7, but I can see over the past 10 years it has had a mean PE of 37.7 and a median of 31.6. Because the PE ratio is currently lower than the mean and median, this could indicate that Nike is currently undervalued. I'm not saying Nike is undervalued. There are many reasons the stock will trade at lower ratios, such as future growth is expected to be lower, future margins are expected to be lower, the risk of the company has increased, or future efficiency or return on capital is expected to be lower. The market is mostly efficient. If you find a stock with a low PE, there is probably a good reason. But I don't think the market always gets it right. I look for companies with low valuation ratios, then I look for reasons to explain why the stock is trading at low ratios. If I can't find any good reasons, or if I disagree with those reasons, then I might be onto a winning stock. Let's summarize. Valuation ratios help you value stocks by comparing what you are paying for them to what you are getting in return. Low valuation ratios might indicate an undervalued stock, but low valuation ratios might also indicate a company with deteriorating fundamentals. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.